What are non-standard option contract sizes? Have you ever wondered what happens when the usual rules of options trading change? Today, we are going to look at non-standard option contract sizes and what they mean for traders. In the world of stock options, the standard contract size is 100 shares of the underlying stock. This consistency helps keep the market efficient and liquid. However, non-standard option contract sizes break this mold. They representing a different number of shares, or even a mix of shares and cash instead of the usual 100 shares. So why do these non-standard options come into play? They usually arise from corporate actions. Think of mergers, acquisitions, stock splits, reverse splits, or spin-offs. For example, after a reverse stock split, an option contract might representing fewer than 100 shares. It could be 25 shares instead. In another scenario, when a company merges, the option contract might deliver a combination of shares from the new entity along with cash, rather than a fixed 100 shares. You might notice that these contracts have unique symbols. This helps traders identify them easily. For instance, a non-standard option could have a symbol like NLY1 instead of just NLY. This change signals that the deliverable size is different from the standard. From a trading perspective, non-standard options tend to be less liquid and more complex. Their unusual sizes and adjustments to strike prices mean traders need to recalibrate their strategies. Because these contracts are not as common, many traders prefer to stick with standard contracts. This choice makes execution easier and risk management clearer. In practical terms, non-standard contracts can create confusion about the actual exposure and value of the option. Since the number of shares and strike prices do not align with the usual multiples of 100 shares, this complexity can lead to wider bid-ask spreads and lower trading volume. To sum it up, non-standard option contract sizes are exceptions to the typical 100-share rule. They are mainly created by corporate actions that change the underlying stock structure. While they reflected new realities of the shares, they also introduce complexities and liquidity challenges that make them less appealing for most options traders. Understanding these differences can help you navigate the options market more effectively.